Welcome to Talk Tickers. Today we're taking a look at the first quarter 2025 earnings for Albrang Incorporated. They're operating as TEDs now, after that big merger with Outbrain.
That's right, big changes.
Yeah, so our mission today is really to cut through the noise. Can this new combined company actually deliver? Can they carve out a real space in digital advertising? Let's get into what the CEO, David Kostman, and CFO, Jason Catt, actually said.
Okay, let's start with the big numbers, the headlines.
Yeah.
So TED's reported revenue around $286 million. That's up 32% year over year.
Sounds great.
It does, but, and it's a big but, that's heavily skewed by the acquisition, right?
Yeah.
So to get let's say, a cleaner look, you look at the pro forma numbers.
Right, the as-if picture.
Exactly. And on that basis, revenue actually looks like it declined about 7% year over year. Now, the upside there is that it's better than the 9% decline they saw the quarter before.
Okay, so still shrinking organically, if you like, but the brakes are maybe being tapped a bit. Less decline is good.
It's moving in the right direction, yeah. Not growth yet, but definitely an improvement on the trend.
Gotcha. So top line is complicated by the merger. What about the bottom line, profitability?
Now that's where it gets pretty interesting. X-Tech gross profit, that's a key metric for them, hit $103.1 million. That's a jump of 98% year over year as reported.
98%. Okay.
Yeah, and what's really telling is that profit growth is way out ahead of the revenue growth we just talked about.
Which means?
It suggests that the mix of revenue they have now, post-acquisition, is, well, much more profitable, higher margins.
Okay, makes sense. And EBITDA?
Adjusted EBITDA for the quarter came in at $10.7 million. Now get this, that's over 7 times higher than the same quarter last year, again, on that as-reported basis.
7 times, that's huge.
It's a significant leap, absolutely. Really shows the profitability impact of the merger, at least initially.
Okay, but merging companies costs money. Integrating isn't free. How's their cash flow holding up with all this going on?
Good question. So free cash flow is actually a use of about $7 million in the quarter.
Ah, okay, so burning cash?
Well, hold on. You have to factor in some one-offs. They called out about $16 million in costs specifically tied to the acquisition and restructuring.
Right, integration costs.
Exactly. So if you kind of mentally back those out, they would have actually generated a positive free cash flow of about $10 million.
Okay, that paints a different picture. So the underlying business is throwing off cash, and their cash balance...
They finished the quarter in a pretty healthy spot, $156 million in cash, equivalents, and marketable securities. So yeah, the merger hit the cash flow number short term, but they've got a cushion, and the underlying generation looks okay.
Right, okay. Good cushion there. So what are they saying about the near future? What's the outlook?
For Q2, the guidance is for X-Tech gross profit between $141 and $150 million, and adjusted EBITDA between $26 and $34 million. So a big step up from Q1.
Yeah, definitely. And for the full year?
They're sticking to their guns. They reiterated the full year 2025 adjusted EBITDA target of at least $180 million.
At least $180 million. Okay, so that implies what things really need to accelerate in the second half of the year.
Precisely. They're banking on a significant ramp up in profitability as the year progresses.
Okay, that's a confident stance. So what's the big plan? What's the strategy that makes them think they can hit that? How do they get there?
Well, their core vision, as they put it, is to build TEDs into the open internet advertising platform, focused on elevated outcomes.
Elevated outcomes, meaning...
Basically covering everything from brand building, awareness campaigns, right through to performance marketing, driving sales or leads. They want to connect what's now a pretty fragmented open internet ad space.
I compete with the big guys, the walled gardens.
Exactly. They're positioning themselves as the alternative to, your Googles and Facebooks, offering maybe more transparency, more control for advertisers outside those closed ecosystems.
Okay. Ambitious goal. The champion of the open internet. Yeah. But what advantages do they actually have to make that happen? What makes them think they can really compete?
They laid out 4 key advantages. First, they talked about direct, exclusive deals with publishers. Lots of them, giving them curated ad inventory at massive global scale.
Okay, unique supply.
Second, an end-to-end platform, optimized, transparent supply paths. They said 50 markets reaching 2 billion users. That's quite a reach.
Yeah, huge audience. What else?
Third is data, their own proprietary data. They threw out a number over 1 billion data points processed per minute.
Wow.
Yeah. And that data fuels their AI algorithms, all aimed at optimizing results for advertisers. And fourth, they have a creative studio to help brands connect with audiences across all these different channels.
Okay, that's a pretty compelling package if they can execute on it. Are they seeing any early signs that this is working? Is it gaining traction?
They reported, solid execution so far, growing momentum. They emphasized a good mix of advertisers, different types, different industries, different parts of the world. And interestingly, they mentioned about 2/3 of the spending on their platform right now is for performance campaigns.
Right.
So driving direct results. The other third is for branding.
So a decent balance, appealing to different marketing goals?
Yeah, suggests they're hitting both sides of that elevated outcomes pitch.
Gotcha. They also mentioned something called JBPs, joint business partner accounts. What's the deal with those?
Right, JBPs. They closed Q1 with over 50 of them. And they named some big new ones. Ferraro, Haleon, Philip Morris International, Bayer.
Those are major global brands.
Exactly. And these partnerships are apparently key because they open the door to servicing, new product lines within those companies, expanding into new countries, tackling different marketing goals. Big potential for growth there.
And expanding within existing partners, too.
Yeah, they mentioned finding opportunities to sell their performance solutions to legacy TED's partners who are mostly just doing branding before and vice versa.
Okay, so landing new big fish and getting existing ones to spend more. What about the overall advertiser base? How does that look?
It's pretty concentrated at the top, actually.
Yeah.
They said about 500 advertisers spend over $500,000 a year with them. The average for that group is over $2 million each.
And that accounts for?
About 70% of their total ad spend. So really reliant on those big players.
Yeah.
But then there's another tier, about 1,000 advertisers spending between $100K and $500K a year.
So a good base to try and grow that share of wallet, as they say, get them spending more.
Exactly. Lots of potential to move those mid-tier clients up.
Okay, switching sides then. What about the publishers, the websites and apps where the ads actually appear?
Still focused on locking down unique, exclusive environments. They mentioned renewing deals with some key names like Redidia, Sancai, TMZ, Cond Nast. Yeah. And they're innovating on the ad formats too. They highlighted something called Moment. It's a vertical video solution, apparently showing really high engagement.
Vertical video, like TikTok style.
Yeah, think that kind of format. They said close to 80% viewability and nearly double the engagement rate of their other branding formats. Sounds like that's going to be a big focus, expanding that vertical experience suite.
Interesting. And the other big growth area they flagged was connected TV, right? CTV.
Well, absolutely. That was a standout number.
Yeah.
CTV revenue surged 100% year over year in Q1. Doubled. Now it's about 5% of their total ad spend. So still relatively small, but growing incredibly fast. They talked about having access to over 300 million TV screens globally.
How do they get that access?
A big chunk, maybe half, comes from exclusive deals with TV manufacturers like LG and Vita, plus access to like 7,000 other CTV apps. They've run over 1,500 campaigns just on TV home screens since 2023. Premium brands using it.
So definitely planting a flag firmly in that CTV space. That's a hot area.
For sure. Huge growth potential there.
It also sounds like the merger integration itself, the nuts and bolts, is going well, especially on costs.
Yeah, they seem pretty pleased with the progress on cost synergies. They said they've already actioned about 90% of the planned annualized savings related to compensation, headcount reductions, basically.
Okay. And the overall target?
Still aiming for $60 million in annualized savings by 2026. They expect to be at that run rate by the end of 2025. And importantly, they actually raised their estimate for savings this year for 2025, now expecting around $40 million in savings, which is up from what they thought before.
So finding more savings than planned or getting them faster. Either way, good news for the bottom line.
Definitely helps underpin that $180 million EBITDA target.
They also threw around the term AI everywhere. What does that mean in practice for them?
Well, they're basically saying they're trying to bake AI into everything. Engineering, the algorithms running the ad auctions, new product features, even their own internal processes.
Any examples?
Yeah, they mentioned one specific tool, an image-to-clip tool, helps quickly create video assets for performance campaigns. Said it's already been used on over $1 million worth of campaigns, so tangible applications driving usage.
Okay. What about the wider world, the economy? Any worries there?
They said they haven't seen a major hit to their results yet, but they are noticing advertisers shortening their planning horizons, their buying cycles.
People getting a bit more cautious, maybe? Scrutinizing spend.
That's the implication, more scrutiny. But TEDS actually spins this as a potential positive for them in the long run.
How so?
Because their whole pitch is about accountable, outcome-based advertising. If advertisers want more proof their money's working, TEDS thinks their platform is well-suited to deliver that.
Right.
Show me the ROI.
Right, lean into the performance aspect.
Exactly. And they did also mention seeing improvement in their U.S. business trends in Q1, continuing into Q2. So maybe some positive signs there, despite the caution.
And are they seeing those cross-selling opportunities materialize? Selling Outbrain stuff to TEDS clients and vice versa?
They said yes, some early wins there. Offering performance solutions to legacy TEDS advertisers, branding to legacy Outbrain ones. They expect that to really start ramping up in the second half of the year as the integration gets smoother.
Okay. One last thing there was that big Google DOJ ruling recently. Any thoughts from them on how that affects things?
Their take was generally positive for the overall ecosystem. They think it could help SSPs, the supply-side platforms that publishers use.
And that helps TEDS. How?
Indirectly, potentially, could benefit their performance business that runs on third-party supply. But they also kind of emphasize that because they have so many direct deals with publishers and this end-to-end platform, the direct impact on them might be less significant than for others. Their direct relationships are a key strength, regardless of the ruling.
Right. They see themselves as maybe a bit insulated because of that direct model. Okay. So pulling it all together then, for you listening to this, what are the really key things to watch going forward with TEDS?
Well, number one is definitely continued execution on that merger integration. That's foundational.
Got to make it work smoothly.
Absolutely. Then their focus on outcome-based ads, does that continue to resonate in this market? Keep a close eye on that CTV growth rate. That 100% jump is impressive, but can they sustain strong growth? And especially, can they make performance CTV a real thing? Hitting those cost synergy numbers is critical for the profitability story. And watch their ability to grow spending from those big existing clients. That share of wallet growth is vital.
Right.
Also, those positive trends in the legacy TEDS business post-merger, are those sustainable? And things like the moment vertical video format, does that really take off? And finally, are they signing more of those big JBP deals? That's a good sign of market validation.
Lots to track there. Okay, let's pivot to our favorite segment. This is not financial advice. Time for some, let's say, creative thinking based on the call. What have you got?
All right. Outrageous but plausible idea number one. We saw that 100% year-over-year growth in CTV revenue, right?
Yeah, hard to ignore.
And they're pushing hard into performance CTV, plus those exclusive deals with LG and Vita. So here's the thought. Again, not advice. What about taking a long position in one of those TV manufacturers they partner with, like LG or maybe Vita's parent company if it's public?
Interesting. Betting on the hardware partner.
Yeah, the logic being, if TEDS really succeeds in monetizing that TV inventory, it makes those smart TV platforms more valuable, maybe drives demand, maybe their revenue shares. It could benefit the manufacturer directly.
Okay, I see the connection. A bit indirect, but plausible. How do you make it outrageous?
Well, spice it up. You can maybe pair that long position with a short position on a, say, traditional cable TV company. Play the whole cord-cutting, ad dollar shifting theme. Bet on the CTV ecosystem winning against legacy TV.
A pairs trade on the future of the living room screen. Okay, that's definitely got some spice. What's idea number two?
Okay, this one focuses on those cost synergies. They're targeting $60 million annualized by 2026, expecting the run rate by end of 2025, and raise this year's estimate to $40 million. That's a lot of potential profit uplift.
Right, that flows straight to the bottom line.
Exactly. So the idea, maybe look at long call options on TED stock with an expiry date out in, say, early 2026.
Betting on the market recognizing those synergy gains by then.
Precisely. If they deliver on those synergies and the EBITDA jumps towards that $180 million plus target, the share price could react pretty strongly. The options give you leverage on that potential upside.
Okay, leveraged bet on synergy execution. What's the hedge or the extra risk?
Well, to maybe add another layer or hedge it, depending on your view, you could consider simultaneously selling put options at a strike price, maybe a bit below where the stock is now.
Selling puts. So you collect premium, but you're obligated to buy if the price drops below that level.
Right. It signals you think the downside is maybe limited in the medium term because the integration seems to be progressing, and you collect that premium. But obviously it has risk if things go south unexpectedly.
So a potentially complex options strategy betting on synergy delivery and limited downside definitely fits the outrageous but plausible category.
Just throwing ideas out there for you to think about.
Love it. Okay, so wrapping up on TEDS. This first quarter as a combined company, it really does show some promise. Integration seems on track. Profit growth looks strong, especially driven by that mix shift. And areas like CTV are booming.
Yeah, the strategy focusing on measurable results, the end-to-end platform, it seems well positioned for where the ad market is potentially heading.
Definitely. So keep watching that CTV momentum, the JBP growth, and critically, whether they hit those cost savings targets. Those seem like the key indicators. And remember, folks, this deep dive, it's just our take to get you started.
Absolutely. We really encourage you to check out the full earnings call transcript yourself, do your own homework. What stood out to you? What questions do you still have?
And maybe one final thought to leave you with. TEDS is trying to build this big, effective alternative to the walled gardens on the open internet, blending branding and performance. If they pull it off, could they become so valuable, so strategically important in that open web space that maybe a larger tech or media player decides they just have to own them? Could they become an acquisition target down the road? Something to ponder. Thanks for joining us on Talk Tickers.